Alright guys, so welcome to this video. In this video we're going to be talking about the one setup for life, right? Remember I'm asking you about this. Can you just give me a trading setup that's it's one and one, right? So what do I mean, right? This trading setup I'm going to give you guys is going to be both a higher time frame setup and a lower time frame confirmation model, right? So welcome to this video. I'm glad to have you guys on this video, right? So if you have not subscribed to the channel, use this moment to subscribe. And if you like this video, right, and don't forget to put a comment to maybe what you understood, what you gained, and any questions you might have. Do want to drop it in the comment section and any recommendations, right? Also, if you'd like to join our inner circle, you can also use the link in the description to join our paid mentorship, where we hold you by the hand. It's not just teaching you random stuff. We hold you by the hands and teach you how to trade properly. All right. So now, one setup for life. Right. So before we talk about the one setup for life, there are things we need to understand, right? And those things we have to understand are: number one, we have to understand what mitigation is. Right. It's just like a topic that latches on others. We have to understand what mitigation is. We have to understand what internal and what external range liquidity and internal range liquidity is. All right, so those are the basic things we have to really understand before we can talk about the one stuff for life, right? So now, what is a mitigation, right? Don't forget to like this video and subscribe. Right now, if I'm talking about mitigation, right, let's assume we have an order block, right? We have an order block, right? We have order block, right? As an order block is this last up candle, right? This is what an order block is, this last up candle, right? So if you extend that candle in the future, like you take maybe a tool and then you extend that order block to the future, right? This is the order block level, right? Now, mitigation simply means when price comes back, right? When price comes back, right, to tap into that candle. Right, these are candles now. When price comes back to tap into this candle, also referred to as mitigation, right? This is also referred to as mitigation. So we have the order block printed there, and price now comes back to tap into this order block. That's also referred to as what mitigation. So this act of the market coming back to tap into your order block or your zone, right? Sometimes it's not an order block. Sometimes it could be a kind of let's say we have some kind of demand zone. So it can look like this. You see some kind of range, and the market breaks impulsively to the downside, right? So now, inside this range, we have created some kind of demand, so some kind of supply zone inside it. The market can come back to this range, right? Can come back to this range, right, and then fall down. Now, the act of the market coming back to tap into this area is what is referred to as what mitigation. So mitigation it comes in different ways. It comes in form of a range, that is a demand or supply zone or an order block, right? So I'm really focused upon the order block aspect, right? Because I don't really trade ranges, right? So now we have to understand that. So that is good. Now you have understood what mitigation is. Price has to come and tap into an order block, right? A created order block, right? And how do you know order block? Order block is that last candle before a heavy move to the downside, or if you're bullish, is the last candle to the downside before the heavy move to the upside, right? So that's what we refer to as what an order block, right? That's last candle before that heavy move to the opposite direction, right? That's what we refer to as an order block, right? We'll go to live examples maybe in the next video, because this video is going to be more of a theoretical aspect, right? Then in the next video, which is going to be on a separate playlist, we're going to look at live examples, because if I want to combine live examples now, it's going to take me a lot of time, right? So this video is going to help you to backtest, right? So you have to backtest on this information. And if you are on my public Telegram, you will see my trades which I take with this concept, right? You just go to my Telegram with this concept, you will see my trades I took with this concept, right? But I'm not going to talk about live examples for the sake of this video. I want this video to be a bit brief, right? So now we have understood what mitigation is, right? It's very, very important to understand what mitigation is, right? It's the act of markets coming back to tap. Now, note something. We have what we call full mitigation and partial mitigation, right? So we have what we call partial mitigation. Now, partial mitigation is when the market does not mitigate it properly. Right? What do I mean? Now, the market can create an order block and then just tap it very little, just a little tap, and the market drops like crazily, drops heavily, right? Now, in the future, the market now comes back again, right? The market comes back in the future Now, what the market has done here is that it has created what we call internal liquidity, right? It has created liquidity here, right? It has created liquidity, right? And then the market does what? The market comes back again to that same order block and then taps it deep, like it goes deep this time around before dropping. Now, what the market has done here is what we call full mitigation, right? Understand this account is I want to understand the concept. Now, sometimes the market can give a partial mitigation where the market just taps the candle, leaps and just runs away. Then later on, it comes back to that same other block and then sweep the high that this former mitigation made, this partial mitigation made before mitigating properly, before dropping. So always be mindful of that. The market does not always mitigate complete. Sometimes the market can just tap just a little, just maybe 25% of the candle and then drop off, or it cannot start just maybe just push in a very little bit before dropping off. Then later on, it comes back to tap the other block properly before dropping down. So the mitigations I like are the ones the market enters at least 50% of the candle. Those are the ones I really trust because I can say, okay, this one has been fully mitigated. Most times when the price just taps it open and just runs away, sometimes price can choose to come back to the candle in the future to tap it properly before dropping off. And now that adds to refer as what? Internal liquidity. Don't worry. We're talking about IRR next, right? We're talking about IRL next, which is what? Internal range liquidity. Right? That's what it means. IRL. Let me just type it out for you guys. So IRL means internal range liquidity. Right? So why the other one is external, right? External range. That's what ERL means, right? It's external range liquidity. All right, so liquidity. So that is it. So you have to understand these two concepts. Now, I hope you guys have understood it. You might need to watch this video, like push it back to the beginning of where I started this explanation. You get a better understanding of what I'm talking about. Right? So that is all about mitigation, right? Market has to come back to that original POI, right? It could be an order block, it could be a demand or supply zone, it could be a range like a consolidation breakout zone, right? It could be anything, right? So it could be an order block, it could be an institutional candle, it could be a breaker block, right? It could be any area where you saw impulsive movements. Like, note, you must see the market run away from that place very quickly. That place is now regarded as was an area of interest, right? And of course, you must always consider the trend of the market before doing that, right? So now, let's talk about what we refer to as let's talk about internal and external liquidity. All right, let's talk about internal and external liquidity. So now, when we're talking about internal and external liquidity, we are referring to a very simple concept. Now, what is liquidity? Liquidity simply means liquidity refers to where liquidity is technically, right? We have two liquidity definitions. From the fundamental aspects, or we refer liquidity as the amount of movement in the market, like money involved in the market. But from the technical perspective, like from the chart perspective, right? From the chart perspective, liquidity is simply what it simply was areas where market participants, right, are likely involved. Right, what do I mean? There are areas in which the markets partners are likely involved, right? Now, most people trade patterns, right? They know all those double tops, double bottoms, and all that. So now most people know that if the market makes it a top and then comes again, right, the market should drop from this double top. Right, that's what we refer to as liquidity. Anyway that someone would like to get involved in the market, right? It's what we call liquidity. And sometimes if a person is in the trade now, maybe a person is buying and then the market is moving bullish, right? Right, market is moving bullish. Now, this old low, the person will likely move what? His stop loss to this low, right? Some people will move their stop loss to here. The market is moving. They likely move their stop loss to this area here, like below this low, because they'll be like, okay, that's a structural low. So they will likely put their stop loss there. Right? As the market is buying, they're moving their stop loss up. Like this would have what we call trailing stop loss, right? They can be looking at that as well, like that trailing stop loss. And then what happens? The market comes and takes them out before they was moving higher, right? So those areas in the market people want to get involved, and some people be expecting what? A kind of double bottom here, right? Some people were expecting the market to create a double bottom and then continue buying. While some that maybe they were buying around there, they'll move their stop loss to break even here, Why those are just getting involved, want to buy there. So we refer to those kind of places as liquidity. So old highs and old lows are the ones we're using here, right? I'm not going to talk about any other one apart from old highs and old lows, right? Those are the areas of the goods we're talking about in this course. So we just be focused on old highs and old lows, right? Old highs and lows. So I don't talk about any other kind of liquidity apart from these two. So old highs and lows are the ones that we're going to look at for this example, right? Now, what is external liquidity? What is external liquidity? External liquidity simply means it refers to, like the name implies, it looks at the extreme regions, right? So external liquidity is when we begin. So we look at the extreme regions. So we look at the extremes of a trading range. So the extremes of a trading range. That was referred as external liquidity, right? The extremes of a trading range, right? For instance, now we have this we are talking about external liquidity now. Talk about ERL. So that's what we call external range liquidity, ERL. All right. So now they're referring to the extremes of a trading range. Now, what do we refer to as a trading range? So the market is bullish, right? The market is creating bullish structure, right? The market is bullish. Now, what is the trading range? The trading range is between what? This low, right, and that high, right? So it's referred to as what? The external liquidity, right? So can I label, can I say, okay, this is external liquidity, can I label it, then put it in small. So this here becomes what? Your ERL. I'm making this one smaller so I can enter there. So make this one a bit smaller, 20. So have your ERL there, right? And then we have what's cooling that, and then we have our ERL down here too. So that was referred to the extremes of a trading range, the extreme low and the extreme high, right? That's what referred to as what? The external range liquidity, right? Extremes of a range. So a range is defined as the distance between the last low and the last high. That was referred to as a range. The difference between the last low and the last high. So that is what is referred to as what? A range. So you're looking at the last low and the last high. That is the range. So that distance is what they refer to as the trading range, right? You can call it a range, right? It's range. So this is the range that is happening here. This range, right? That is the range, right? So that is what the range is between this high and then this low. That was referred to as the range, right? Do you guys understand that? Right. So now let's talk about analysis. Now we have understood what it all right. We have understood what it is. Now, what is internal liquidity? So internal liquidity can be seen as what? It can be seen at what? Highs, right? Highs and lows within a bigger range, right? So we're referring to those highs and lows that are within a bigger range, right? So that was we call as liquidity. So those highs and lows within a bigger trading range, right? So that was referred to as what external liquidity. So internal liquidity. So that was it is the highs and lows inside a uh, inside a bigger trading range. So that was internal range liquidities, right? Inside this bigger trading range. Sorry. Inside this bigger trading range, we usually see what we call internal range liquidity. Why? Because it is inside. So inside this range now, we can see the market can form what? Highs and lows, something like this, right? Inside it. So now this was referred as what? Internal range liquidity. So inside this range now, the market can form this kind of structure. You see a high, we see a low. So this structure inside this high, inside this bigger range is what we refer to as what? The internal range liquidity, right? It could be in form of a high and low, it can be in form of a trend line, right? Sometimes the market can look like this. Let me just take this back a bit. Sorry. I want you guys to understand this thing very well, so you guys will not make mistakes. Now, why the market is going to make a high, you can see the market do something like this. Right? Market can do something like this. And then make what now? Now, what we have here is what we refer to as what? The internal, this structure inside there is what we refer to as the internal range liquidity. Why the external is what? This extreme high and this extreme low. So all this structure forms inside there is what we refer to as what? Internal range liquidity. So the market usually does what? Goes to take all this liquidity out before doing what? Buying. So most times, if you have maybe an external order block here, right? You have an external order block. The market will likely do what? Take out all this internal range liquidity before doing what? Tapping the original what? Order block there, right? So always be mindful of that. Make sure that your order block is not inside the internal range liquidity, right? This is where many smart money traders get it very wrong, right? They're always trying to buy internal range liquidity. So all these things become internal range liquidity. Some of them even want to go and sell it. We want to be like, okay, market, that is what you guys go through when you don't understand structure, right? Some people want to go and sell this. They'll be like, okay, double pop. Market to take them out. So all these highs and lows inside this overall trading range is what we refer to as what? The internal range liquidity, right? Internal range liquidity. That is all it is, right? So I hope you guys understand that whole idea. Now let us talk about the one setup for life, right? Now, what is this one setup for life? Now we have understood mitigations, we have understood everything we want to talk about. Now let's talk about the one setup for life. The only setup you need for life. You can take this as a why is it a one setup for life? Because it is both a higher time frame setup and a lower time frame entry. So it will serve you two purposes. The first purpose is that it will serve you as what? A higher time frame what? Bias or setup, right? You can ask as a higher time frame bias or setup, and it can also ask as what? A lower time frame entry. So it serves two purposes. It's just a one setup for life. You can use it as your higher time frame setup and your lower time frame was entry, descending. Now, what is this one setup for life? Now, for a bullish example of the one setup, let's talk about the bullish example. Right, so the bullish example now of this trading model, very, very easy, right? Look at the bullish example of the one setup for life. Now, this is a bullish example now, right? So let's just divide this so you can understand it, right? Follow me. Now, the bullish example is very simple. When the market is when the market creates some kind of change of character, right? We have the market do something like this and then break another one. So now this is the model, right? Now understand this. This is the trading model, right? Market was bearish and then it gives what? That break of structure or change of character here. So you see your change of character here, right? This is the one setup for life. You see your change of character here, right? Now, you now see what? Remember what I told you guys about mitigation. You have your own mitigated area here. That means market has not tapped into this point. So you have your own mitigated area here. Remember what I told you guys earlier about mitigation. So you might watch the beginning again. And the market must tap into that area before it is regarded as mitigated. Sometimes the market can do what? A shallow tap, which is what's the effect as what? A partial mitigation. The market can also a very shallow tap here. What also referred to as a partial mitigation, right? But most I like to see the price, well, I like to see it's not tapped to at all. So markets can give a partial mitigation or none at all. So what makes this probable is that the market does not tap the POI or it taps it partially, like just a shallow touch. Right now, market breaks, right? So now what do? We now say, okay, this is what our external range liquidity, right? This is our external range liquidity. Let me make that smaller. I want you guys to get this thing. Just get it. Get this setup. Get it. All right. So now we have what's that? We have our external range liquidity form here, right? And then remember that it's the extreme low. Now, where is our extreme high? Right? Where is our extreme high? Remember I told you guys about the external liquidity. Oh, don't forget. Now you have what we have the external range liquidity above here, right? Now we now have what? This to act as what? Our internal range liquidity. Why? Because it did not tap into. So this low now becomes what? Internal range, right? This low now becomes internal range liquidity. All right. Can you see it? And now what do we expect? We expect price to come towards our original POI to pick us and then run higher. That is the whole setup for life. The one setup for life. One setup for life, right? Just this is the one setup for life, right? The one set up for life, right? No, nothing big, nothing much. Now, this model is what some people have called ABCD pattern, right? Some people it doesn't matter the level. Some people would be like, okay, this is the A leg, right? Some people will be like, okay, this is the A leg, right? Some people will be like, okay, this is the A leg, right? Some people will be like, okay, this is the A leg. This is the B leg, right? Some people will be like, okay, this is my A leg. This is my B leg. Like, okay, this is my B leg, right? So that's some people you look at. Some people will be like, okay, this is my B leg. B leg is really what? The external range liquidity, and then we have what our C leg above here, right? That's how some people see it, right? So this is the model, right? So that is the model, right? That's how some people see it. Remember, don't forget what I told you guys. Right, so we have that. Sorry, we have that. Right, so this is it. So some people will be like, okay, this is my C leg. Okay, external range liquidity. That is it. So some people, this is how some people see their own. Right, they see this way. They see their own structure this way. Right, this is how some people see their own. Right, this is all they look for. So now, if you are taking your trade now, you can say, okay, let me buy at this A leg, right? Oh my God, what is this guy? This is 17503. So 17503. Let me just type it out. I don't know why it's not coming up. Oh, so the TP level, take profit level is 17503, right? Why the stop loss level is around 17370. Okay, 17370. Right, that if it's going to work. Oh my God, it's not working. All right, so that is basically it's maybe I don't know what's wrong with my long position, why it's not activating. Right, I don't know why it's doing that. Let me try the shots. All right, so let's just leave that one for now. So just get it for now. Just get it. So that is one setup for life, right? That is one setup for life. So we have all this, right? We have all this forming. This is the A leg, the B leg, and then the C leg. All right, that is the one setup for life, right? One setup for life, and obviously your target should always be what? This high. All right, so that should be your target. This high. This leg is usually your target, but some people like to use what we call fib extensions level. So they will likely put their TP at minus 0.27. So they put their TP at 0.27. So that's another profit target level you can use, minus 0.27. Right, so make that as your overall take profits, right? Just above that point, right? That is it. You can use that for your setup, right? This is the one setup for life. One setup for life. So that's the one setup for life you can use on your trades, right? One setup for life, right? That is the one setup for life, right? Right. So that is it. So now this model is both an entry model and a setup model, right? So now when you have this, you can use it for your lower time frame entries as well, right? Create for lower time frame entries. So now when the market comes inside your POI, as your POI is here, right? Market comes to your POI, inside this POI, you're still looking for the same thing. So the same model inside there. When market hits here, you can look for the same model too. Market should also do the same thing, the same thing that you did earlier, right? Market should do the same thing on the lower time frame for your entries, right? The same thing, right? That should be the same thing you're looking out for when the market hits that other block, right? You can look for the same thing inside there. So this is your higher time frame, right? Let me just put it at the side. So this is your higher time frame. I want you guys to get this thing, get it once and for all, get it. So this is your higher time frame, right? Why this is your lower time frame, right? This is your lower time frame, right? So that is it. So the same thing that at the left, at the same side, the right, right? The same side, the left, the same side, the right, right? That is basically what you're looking for, right? That is the same thing you're looking for. So the higher time frame and then the lower time frame, the same setup, right? The same model. So use it for your higher time frame confirmation and then your lower time frame entry. The same thing, the same thing. So the same ABC internal liquidity model. That's the same thing you're looking for, right? And now the whole thing, I think I should just take it out and just do it again. So now for we're going for a bullish example. Let me just try to replicate for bearish example at the left here, right? Let me just replicate it at the left. So let me just clone this. Right, so let's clone this now and name it bearish example, right? Follow me. So now for a bearish example, it's almost the same thing, right? The market has to give you what? That market has to give you what? That bearish change of character, right? So you have the market sweep and then break downwards. Now the market does what? Break again and then does what? Comes back to activate you. So now this now becomes your entry, right? This now becomes your entry. This unmitigated portion here, right? So you now have that. So it's still the same thing. Remember the same thing that we did here. We have our A leg, right? We have our A leg. We have our A leg there. Sorry, let me just take it out. So we have our A leg at that point, right? Still the same thing. We have our B leg, which is our internal liquidity. So B leg is always what? Internal liquidity. B leg is always internal liquidity. So you have your B leg there, and then you have your C leg, right? So your C leg is the final, the last bus stop, right? The last bus stop, your C leg. And remember that the C leg is external liquidity. So you now have that, and then markets can come to your A leg and give you entry. Now, notice something. I want to make something clear. Now, market doesn't always have to get to your A leg. Once the market sweeps the B leg, you can start looking for what? Lower time frame entries. So this B leg is really what we are looking at for. We want the market to sweep that B leg. So when the market sweeps B leg, you can start looking for what? The same model. Remember that when the market sweeps this B leg, you can start looking for the same thing. Remember, don't forget, you look for the same thing on the lower time frame, right? The same thing on the lower time frame. This is the same thing looking for what? On the lower time frame. Remember, this same thing, when the market hits your POI now, you're looking for what? The same thing on the lower time frame. This same thing, maybe the 1 minute or the 5 minutes or the 15 minutes, right? So you have to decide what time frame to use. And note that it is unwise to be using your maybe the weekly, right, for the higher time frame, right? And then you're not using what? The 1 minute for lower time frame. There's no sense in that. The time frame have to be a bit close. So if you're using weekly, you can go with maybe the 4 hour or the daily. So you can go with the 4 hour for lower time frame, right? You can go with 4 hour for maybe lower time frame, right? Or if you're using maybe the daily for higher time frame, you can stick a daily higher time frame. You can use maybe the 1 hour for lower time frame, right? You can use the 1 hour for lower time frame. Or if you're using the 1 hour as lower higher time frame, you can maybe use the 1 minute or 5 minutes, right? You can stick 1 minute, 5 minutes, 1 minute or 5 minutes for lower time frame. So the time frame should be a bit close for you to identify it, right? So that is basically how this thing works. So remember that the A leg and the C leg are both external range liquidity, while the B leg is the internal range liquidity, right? So this is the whole setup. So in the next video, which will be on this series, we'll be talking about the application of it on the real chart, right? I also want this part to be the theoretical aspect. Then on the next video, which will be dropping in no distant time from now, then we'll be talking about what? The lower time frame. So if you want to, I have done deeper teachings on this in my paid group. If you want to be part of my paid group, use the link in the description to join us before the price goes up, right? So I'd love to see you guys in the next video. So have a wonderful day. Cheers and God bless.